Hello everyone and welcome in today's lecture with Miss Ahal. In today's lecture, we're gonna be talking about accounting and some other concepts related to accounting. So let's get started. Now to start with, we're gonna define what is accounting. Now, in its most basic sense, accounting describes the process of tracking an individual or company's monetary transactions. Accountants, who are the people who work in accounting, they record and analyze these transactions to generate an overall picture of their employer's financial health. There are types of accountants, which we can find certified public accountants and management accountants, which are two of the profession's most common specializations. We might find like management accountants known as cost accountants. We might find auditors اللي هم المدققين, okay, and forensic accountants. They are another important branch of the field. Now let's go and see what are some concepts related to accounting. Now the first concept is accounting period. An accounting period defines the length of time covered by financial statement or operation. Some examples of commonly used accounting periods include fiscal years, calendar years, and 3-month calendar quarters. Some organizations also use monthly periods. Each accounting period covers one complete accounting cycle. Now, an accounting cycle is an 8-step system accountants use to track transactions during a particular period. The next one, which is accounts payable. Accounts payable, which tracks money owed to creditors. Examples include bank loans, unpaid bills and invoices, debts to suppliers or vendors, and credit card or line of credit debts. Rarely the term trade payables is used in place of accounts payable. So either you say accounts payable or you say trade payables. Accounts payable belong to larger class of accounting entries known as liabilities. Now we've got the third term or concept, which is accounts receivable or AR. The accounts receivable tracks the money owed to a person or business by its debtors. It is the functional opposite of accounts payable. Accounts receivable are sometimes called trade receivables. In most cases, accounts receivable derive from products or services supplied on credit or without an upfront payment. Accountants track accounts receivable money as assets. Accrual basis accounting, or simply accrual accounting. It records revenue and expenses related items when they first occur. In general, large businesses and publicly traded companies favor accrual accounting, and small businesses and individuals tend to use cash basis accounting. So the large businesses or companies, they do prefer the accrual accounting, whereas the small businesses and small companies prefer cash basis accounting. Now, what are accruals? These are revenues and expenses recognized by a company but not yet recorded in their accounts are known as accruals. By definition, accruals occur before an exchange of money resolves the transaction. For example, a company that hired an external consultant would recognize the cost of that consultation in an accrual. That cost would be recognized regardless of whether or not the consultant had invoiced the company for their services. Assets. The assets are items of value or resources that a business owns or controls. More technical and precise definitions specify two technicalities. First, assets result from past business activities, and second, they will or are expected to generate future economic value. They come in many types and classes. The types include current and non-current, operating and non-operating, physical and intangible. And the classes include broad categories such as cash and equivalents, equities, commodities, real estate, intellectual property, and fixed income, among others. Now we have another concept, which is balance sheet or statement of financial position. It is a standard financial statement. It specifies the business current state regarding its assets, liabilities, and owner's equity. Some sources abbreviate the term by BAL. We've got capital. Now, in common usage, capital, or as abbreviated the CAP, refers to any asset or resource a business can use to generate revenue. A second definition considers capital the level of owner investment in the business. The later sense of the term adjusts these investments for any gains or losses the owners have already realized. Now we've got cash basis accounting. Cash basis accounting. It records revenues and expenses when the money involved in each transaction officially changes hands. It contrasts with accrual basis accounting. Accrual accounting recognizes revenues and expenses when they occur without regard to whether the associated funds have been exchanged. And the last concept, which is cash flow or CF. The cash flow describes the balance of cash that moves into and out of a company during a specified accounting period. Accountants track the cash flow on the cash flow statements. That's all for today. Thank you so much for your attention. And please, if you don't understand anything, don't hesitate to ask in the comment section below, or just click on the subtitling button to more explanations.